All right, everybody. Thank you very much for joining us. Yes, it is 8:30 p.m. here on the East Coast, just outside of Philadelphia, Pennsylvania. I had a question as to where I was located. Rahad, I am just outside of Philadelphia, about, I'd say, 20 miles. So close enough to the city that we can get in. Um, and but as long as it's not rush hour, that's great. That's great. So you're local to Pennsylvania too. I know we do have a lot of people from a lot of different places. A friend of mine from the trading room is here, and Parmajit, he's actually in Vancouver, British Columbia. Have someone in my trading room. He's from Germany, so it's pretty wide range of people where they're located. That's what's so cool about everything being internet based nowadays. So I can share this information with a lot of people. So, all right, we have a lot of people with us tonight. Very glad to see that. I am. Hi, Michael. Yeah, there, my friend from Germany, Michael. I'm glad you're here. Oh, it's Sir, it's really late. It's really late. Isn't it 5 hours ahead? Oh my goodness. Good morning. So I will try to do my best, make it worth your while that you staying up. 2:31 in the morning there. Oh my goodness. Well, that's amazing. So thank you very much for taking the time, Michael. Try not to keep you up too late. All right, everybody. Again, we'll go ahead and get started. We've given everybody about 2 minutes. So we will go ahead and get started. Oh, wow. There's someone. It's 9:30 in the morning there. Ahmed, where are you located? That's Malaysia. Oh, my goodness. That's really cool. Thank you very much for joining us, Med. I appreciate that. And at 9:30 in the morning. Well, enjoy your morning coffee while you listen to us. Okay. Well, thank you again, everybody. Good evening. Good evening to you if you're very late, and good morning to you if you happen to be in Malaysia, like our friend. Just want to say thank you very much for joining us for our Tuesday night webinar series. Again, my name is Dave Aquino, and I am the Options Live Trading Room Specialist here at Microquant. And we'll just go ahead and get started with our webinar for tonight. And the topic is trading intraday channels with options using value charts and value bars indicators. I kind of bundle them all up as value charts indicators, but we're using value charts and MQ momentum type indicators. So we'll go ahead and go through that, this particular strategy, and how to use the indicators to carry through. Okay. Just a quick note about any questions that you might have. Go ahead and submit them in your GoToWebinar side menu, and I will try to answer them as we're going if they're pertinent to the discussion we're having right now. If not, I will try to answer them at the end. I try to make sure everybody has their questions answered, and that you also have access to me afterwards in case you have any questions. We have another visitor here from Italy. He's saying it's 2:30 in the morning there. That's amazing. Thank you again, everybody, for joining us, but especially those our friends in Europe and in Malaysia. The very different time schedules here, so that's wonderful that you can join us. Thank you. All right, well, really quick risk disclaimer. We at Microquant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Now, before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. Now, this content is subject to change without any notice, and it's for the sole purpose of education and assistance in making independent investment decisions. Now, we've taken reasonable measures to ensure the accuracy of the information. However, we can't guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or such information, or delays or failures in transmission of this information, or any instruction in connection herewith. Now, any past performance results are shown for illustration and example only. They are hypothetical and inherently have many limitations. Now, no representation is being made that any account will or is likely to achieve profits or losses as shown. Most important thing, past performance is not necessarily indicative of future results. Okay. Now, the CFTC Rule 4.41. Now, this is a U.S. government required disclaimer. The CFTC wants you to know that futures and options trading not only has large potential rewards, but also carries large potential risks. You must be aware of these risks and be willing to accept them in order to invest in the futures and options market. Now, don't trade with any money that you cannot afford to lose. This is neither a solicitation nor an offer to buy or sell futures, stocks, or options on the same. Now, no representation is being made that any account will or is likely to achieve future profits or losses similar to those discussed on this website. Now, any past performance of any trading system or methodology is not necessarily indicative of future results. If I could promise you that, I would, but you all know as experienced investors, this is something that we do our best to represent as best we can. But again, past performance is not indicative of future results. Okay. All right. Now, before we go ahead and start talking about our indicators. Okay. Again, what we're going to be talking about is trading intraday channels with options using our value charts indicators. So before we start speaking exactly on the actual indicators themselves, I want to quick touch on what we consider the three components of technical analysis. Okay. Bear with me one second. Here, let me get my pen. Okay. The three components of technical analysis: price. Now, we always see that. A value, that is something, objective value is something that is unique to value charts. And then momentum. Now, you've maybe used momentum indicators in the past, but I'll introduce you to our value charts MQ momentum indicators, and they are slightly different, and the way we use them with our value bars and value chart system is unique in the industry. So we'll show you how to combine all three to get a complete picture of the current makeup of any market. Okay. Now, the tools that we're going to use to view these three components of technical analysis are first price, the first component, and we're going to use the traditional price charts that you normally see, the open, high, low, close bar charts. Now, for value, objective value, we're going to utilize the value charts and the value bars indicators, specifically the value bars indicators. For price momentum, we're going to use the MQ momentum indicator itself. Now, I'm going to throw in one more MQ momentum indicator in there, and we use this in the options trading room all the time. It's MQ regression, and we're going to use it to help us identify the direction of the trend. Okay. Now, again, to quick show you, the nature of our objective value indicators is specifically value charts. Now, what we normally talk about in the financial industry, when we talk about value, it's usually subjective, that an analyst or a fund manager considers certain stocks undervalued based on some underlying evaluation of the current company, or the historical, PE multiple or something like that. The way we use value in value charts and here at MicroQuant, we actually produce the objective evaluation of value based on real past prices within a historical analysis period. Now, through value charts, that's what this indicator is right over here, we actually place the current price within 5 valuation zones. The first green zone here in the center is considered fair value. Then above and below that, we have moderately overvalued and moderately undervalued levels. And then above and below that, we have significantly overvalued and significantly undervalued evaluation levels. Now, based on the default settings, roughly fair prices are in fair value roughly 66% of the time. Okay, in moderately overvalued, prices are in that zone roughly 16% of the time, and the same with moderately undervalued, roughly 16% of the time. Now, in the red valuation zones, prices are in those zones only 1 to 2.5% of the time combined. Okay? So what you will notice is that these prices are normally now these percentages can vary slightly depending on the markets you trade, maybe the speed at which prices are developing, or the indicator settings that you use, but normally prices stay within fair value majority of the time, but periodically enter these yellow and red valuation zones. The most important feature of that is that you notice how often prices are in these extreme zones, and that if we do enter a moderately or significantly overvalued or undervalued levels, prices have a tendency to move back into fair value. Okay? All right. So again, these are our traditional open, high, low, close bar charts. Now these charts have been used by traders for over 100 years, and they're great at showing price over time. Okay? That's basically what you're seeing here. Each bar represents price movement for a specific period of time or for a specific number of transactions, and we know those as tick charts. Okay? Now, what we do here, hold on, I'm sorry. Now what we've done here on the next chart, we've actually taken the 5 valuation zones from value charts and actually imprinted them onto an open, high, low, close bar chart. As you can see, this traditional chart has the open of the chart, the first price of the bar in fair value, and then we have the body goes through from green to moderately undervalued, the yellow, to significantly undervalued, the red, and that's where it closes. So not only do you get to see the price action and the way price moves up and down in the bar, but we also get to see the value chart's valuation at the same time on the same bar. Now when you are trading very quick markets, it helps not to have to look at 2 different sets of bars. Everything, and specifically that's value charts and value bars at the same time, so that we see it all in one bar. Okay? That way you can identify both price and value very, very quickly. Okay? So that's the value component. This now is MQ momentum. You can see again price and value on these value bars. Now we add MQ momentum. Now MQ momentum is very similar to a moving average convergence divergence indicator, also known as MACD. But MQ momentum is actually a proprietary indicator designed by Mark Helwig. He's the founder of Value Charts. Now Mark took the components of his favorite momentum indicators and basically created a hybrid, and it kept the most important factors together. Basically, the MQ momentum is made up of a fast line, this solid line. You can see it move along here. And then we have this dotted line. It's a slow line. You can see it right in this space here. And then we have the histogram. Now the histogram is both has a negative feature and a positive feature. If the fast line is below the slow line, the histogram is negative and it is red, and this shows a bearish or downside momentum, a negative momentum. When the fast line crosses above the slow line, we have a crossing here from red to green. Now the green bars are both positive and bullish, okay? So that as long as the fast line is above the slow line, we maintain this bullishness to price momentum. So when the histogram bars are red, prices tend to fall. When histogram bars are green, prices tend to rise. Okay? Okay. Looks like no one's have any questions. Like I said, feel free. If something comes up, go ahead and post your questions. I'll be happy to try to address them at the time. Okay? Now, our next indicator is MQ regression. Now, what we use MQ regression for is basically trend. Okay? Oh, okay. Let me quick back up here. There was a question about the blue line. Oh, I see. You're asking about this line here and this line here. Basically, these are our boundary lines. When the height of the histogram bars are, well, actually, it's the indicator line here. When it reaches a factor of plus 25, it'll be above this area here. If it's a minus 25, it's this area here. It's basically our way of defining a particular boundary. It does not hamper the formation of this indicator line, but it gives us an idea how far away from the zero level the current indicator line is. We use that sometimes when we have an extreme move, either to the upside or to the downside. And in our options room, we make note of that because basically I call it my rubber band theory of MQ momentum. The further you get away from the zero level, the higher the likelihood of this to snap back towards zero. You know, if the line is only here maybe -5, -6, well, you don't have much elasticity built up that pulls it back to the zero line. But when we're way up here, plus 30, plus 40, plus 50, you really have a lot of strong movement to the upside. But then it also states that the snapback could be quite drastic also. That's what these lines are for. Okay, and yes, this webinar is being recorded. Okay, thanks for those questions. Now again, the next MQ momentum indicator is MQ regression. Basically, how I use it is to define the trend. Here, you'll get to basically see MQ regression is designed to serve as a basic trend filter. If the MQ regression line is green, then the market is bullish and it's okay to go long. If MQ regression is red, then the market is generally bearish and it's okay to go short. What you don't want to do is, if you are trying to follow a general trend, you want to stay on the correct or the right side of the trend. If the trend is down, then we are in a bearish kind of situation. You don't want to necessarily be going long this or being bullish when the trend is down. Now, you're talking to me. I am a counter trend trader, so I will do that under certain circumstances. But what's important to know is that the higher probability trade would be to trade this to the downside. Okay? Now, there are certain situations in which where we define where we get in, and that's the purpose of this webinar. Define our entry point. It's an important factor in trying to find the trend. But what you generally don't want to do is, if the trend is down, you don't want to be looking to profit from a move to the upside. Okay, and then when the trend is green, the same thing. You want to be able to take positions that are with the trend, and you want to try to catch a move going up. Now the question is, someone asked me, is this a daily chart? Actually, this is an intraday chart. Looks like it is a 15-minute or 5-minute chart. It honestly doesn't matter. MQ trend, MQ regression functions the same way. Okay, in this line, is not exactly, it's not even a real line like an exponential moving average or a simple moving average. Its location is a little bit, it's independent of the price. It just happens to once in a while be in the same path as the stock price, but it's not saying like, oh, we're hitting support here. It's not the case. What's important is just the trend. And the way we also use it is you take note of the slope of the line. Is it flat or is it steep? Is it steep like this, or is it getting shallow? So this is a negative slope, this is a zero slope, this is a positive slope. That it becomes important later on for changes in the trend. It has to go from negative, it has to go through the zero slope before it turns up, and vice versa. If we come over here, it's positive, it goes to a zero slope before it starts to go down. Okay, so that's basically what you can get from MQ regression. The trend as well as the steepness of the trend. Okay, no more questions? Excellent. Okay. The indicators and their settings, again, we're using primarily value bars, and we use a 5-bar analysis period. Any of you that actually own the value bar system, these are the settings that I'm using. For MQ regression, we actually increase that to a 100-bar analysis period. It smooths it out a little bit. It makes it a little bit more lagging, but it tends to hold the trend a little bit better. And then we use MQ momentum, and it's the default 3255 setting. Okay. And it's for I don't change these when I change the time frame. I trade these particular settings when I'm trading 3-minute charts, 5-minute charts, 60-minute charts, 250 tick bar charts. It's all the same. Sid, excuse me, I had to take a drink of water there. 3255, that's the actual setting. If you go into your MQ momentum indicator, you'll see that's the default setting. If I have a chance, I'll show it to you later. Okay. Now, this trend following type of trading that I'm going to show you, trading the intraday channels, I'm going to show you with the example of using the S&P 500 index ETF, the spiders. It doesn't have to be the spiders, but the process is the same. I'm sorry, I'm reading the question. The process is the same for ETFs as well as individual stocks. We use it primarily for individual stocks in the trading room, but it's just an example. Mr. Bill, I'm not quite sure what your question is. I'll show you in a little bit how we use the options, but I want to show you on the actual ETF chart and continue for that. Yes, MQ momentum can be used for options also. Okay, just a quick primer on the S&P 500 ETF. 500 largest companies in the U.S. It makes up 80% of the U.S. total stock market capitalization by value. Highly diversified blue chip stocks. They're very liquid, and the options themselves have very tight strike prices, 50 cents and the even dollar amounts. So 50-cent increments provides you a lot of trading capability there. Okay, so now why do we trade these spiders with options? Can we just buy and sell the ETF? It's true. But remember the definition of options. It's basically a trading vehicle that derives its value from the characteristics of the underlying, whether it be a stock, an individual stock, or an ETF. Now, why do we use them if we're going to try to trade Again, can't we just buy the ETF? Well, the first advantage by using the options is leverage. Now, right now, to buy one share of Spiders, trading about $161. Okay, versus let me double check that. Yep, that is correct. Versus the option. Now I can control with $3.06 the same amount of stock. Okay, and this is specifically a Delta 70 that has about a Delta 70 call or put. Actually, it doesn't matter. And then it's something that's about 10 days out. Okay, and there's a defined risk. If I'm going short the Spiders, this thing could just run straight up into infinity and beyond. It is not going to, but that's my risk. With options, if I buy a $3.06 put, I spend $360. That's the maximum I can lose. Okay, even if it goes to infinity, the maximum I can lose is $3.60. Okay, it's a highly liquid market. Also, the Spiders options are probably one of the most liquid options out there. Now, things to watch out for specifically is time decay. Okay, usually we trade the weekly options, again, that have about 10 days left. So time decay becomes a factor as we get closer and closer to expiration. And then commissions. Relatively so, commissions are more expensive on options than they are on stock. Some day trading firms, you can get in and out a couple of dollars. Here, with options, depending on where you trade, you might get charged $250 a contract to get in and $250 a contract to get out. So it makes a difference. Okay. So, but basically, these are the factors that that make it both useful to trade options and some things to watch out for. To be honest, I do run the options room, and I don't think I can't do nearly the same amount of. I can't produce the same amount of profits trading stock as I can with my options. Especially this is the big thing for me, leverage. And then this is also for our weekly trades, except I take advantage of time decay. Whereas option buyers have to worry about time decay. We're option sellers in certain time frames. So we'll talk about that too. Okay? All right, so why options? Now, the way we're going to use this options for our specific strategy, we're going to be directional. Okay? Very straightforward. Basically, what I am going to do is buy a Delta 70 call if we are in a bullish trend and I believe that the price will continue to rise. Straightforward. I think it's going to go up. I buy a call, specifically a Delta 70 call. I say usually minimum 10 days to expiration, Med. It depends. It depends on how long I'm going to hold it. Let me just work through the examples and you'll see what I can do, and then I can try to get into the specifics. Okay. 10 days, something that's a little further away from the expiration, because I'm buying the stock, I'm buying the option, so that the weeklies, I really don't want the time decay to become an issue when we're talking about the actual trade. That's all. Okay. All right. So basically what I'm doing, I'm using the option as a surrogate for buying the actual ETF. Okay. I think it's going to go up. I buy the call. I think it's going to go down. I'm going to buy the Delta 70 put. Very straightforward. Again, if it's a bearish trend and we believe the prices are going to fall, we buy a Delta 70 put. Okay? It's kind of, what's important for you to get is the theory about, where do we buy, what options do we buy, when do we kind of look to sell. Okay? All right, so trading intraday channels. Now, I took the liberty to be a little bit free when I say intraday channels. What am I talking about? I'm actually talking about using a time frame that produces a lot of bars within a day. Okay? This same idea can be extrapolated to longer term charts, but specifically so I can show you an example, we're talking about intraday channels. Now, when I say channels, I'm using trending channels. I can adapt it to where it's basically a flat day and we have a sideways channel, but I try to, if we're going to trade channels, I prefer something with a little bit of a trend, either a trend up or a trend down. Okay, so let me just work through the examples and then I will look up for any possible questions. Okay, I'll try to leave this up as I'm talking so you guys can copy it down if you want. But basically what we're doing, again, looking for a time frame that has a lot of bars. So I'm looking to find the trend of the spiders. Now, again, spiders, I'm just using the ETF for example. You can use individual stock if you want. But I'm looking for the trend of on a 2 to 3 minute chart. I'm looking for a channel pattern, okay? If the MQ regression line is green, then the trend is bullish. Then I'm looking to buy calls. Now, the trick is, how do I get into the trade? I'm actually looking for a moderately undervalued. This is key. I'm bullish, but I'm looking for an undervalued level. It is a lower yellow bar segment. Now, this can be red also. I'll talk about that when I show you the example. But the important thing is we think the price is going to go up, but we're looking for something that's undervalued. And I'll show you then the example. So just keep that in mind. And again, on the flip side, if MQ regression is red, then the trend is bearish. We think prices are going to go down. So we want to buy puts. And again, we're looking for a moderately, in this case, overvalued. We want an upper yellow bar segment to get in. Now, we are always looking to utilize value and enter at a value level. That's what the upper and lower yellow bar entry points are. And then we look for prices to move back towards the trend. Okay? That basically talks to how we identify the trend. Again, look for a channel and then look to MQ regression. If MQ regression is bullish or green, we're looking for an undervalued price to get in. If MQ regression is red, the trend is down. We want to buy puts, and we're looking for a moderately overvalued location to enter the trade, to buy puts. Okay? All right. So that talks about getting in. Now, what do we do once we're in? We hold the position as long as the trend persists in whatever direction that is. Okay? And then we have an exit strategy. First of all, once we get price separation from our entry point, it's okay to move our stop to break even. Okay? Or even to take partial profits. But most people say, okay, I'm just going to move to break even. What we also can do is if we get in at a moderately overvalued level, we look to, and it's falling, we look to go ahead and sell at a lower yellow bar segment. Okay, so this is yellow, we get in, we look to yellow to get out. Okay, and vice versa. If we see that this is bullish, well, we look to buy yellow down here and to sell yellow up here. Okay, but we'll talk about that when we look at the charts. That's one thing we can do also. Now, another thing is also we can hold the position until this MQ regression changes color. That's another way we can do it. So you can actually move to break even, take partial profits, get out at the opposite value level, or when MQ regression changes color. What type of profits are you hoping for with this strategy? It's a good question, Brad. It's hard to define it in terms of dollar amounts. It's basically, it depends on the trend. It depends on the average true range of the ETF or the stock. It depends on how strong the trend is. If you're chopping around in basically a sideways pattern, then you're getting smaller moves. So even if you're buying at the opposite value level, it may not move enough. Your profits may be more limited. If you're in a stronger trend that's moving up, and if you get enough volatility within those individual bars, and you get those entry levels, then you have a larger potential to make money. Again, we're trading with options, so we're actually benefiting from the price action because of the leverage, but you have to be careful. Okay? Sure thing, Jim. So let's just walk through this and basically go through the steps. That way I can you guys can see it and you can ask questions. Okay? First of all, I come in the morning, I put this on, and I'm just say we're right at this level right here. Okay? Where it's we first identify, it looks like there's a bit of a channel right through here. Okay? And MQ regression is what color? It's red. So we're looking for this to be bearish, to go down. So the next thing we do is, okay, now we know we've said that the trend is down, that the intraday channel is down. How do we buy this? Do we buy it here? It's going down, right? Do we buy here? No. That's opposite of value. Best way to think of value is this. This is the price of a car, this range. So you're looking to buy yourself a new Mercedes, okay? Down here, they're selling for, wait. No, that's a bad example. Hold on. Sure, it's not the Mercedes, trust me. I'd be happy to have a Mercedes myself, but okay, here's a good example. Here's the range of the price of the Mercedes. Okay, down here it's 20,000. Cool. Up here it's 40,000. Where do you want to buy? It's the same car, same model, same everything. Where do you want to buy it here? Okay, I want to buy it down here. I want to buy it at 20 because I know that the true value is probably somewhere in here. Now, if I bought it at 20 and like, oh man, I have to sell it. I need to raise some cash because I have this great investment opportunity. I have to sell my car. Where do I want to sell it? Do I want to sell it at 20? Do I want to sell it up here at 40? It's the same car. It's just somebody's willing to buy it from me at 40. So this is where I want to sell it. So when you want to buy and the trend is going up, you want to buy here where it's yellow and sell up here where it's yellow. Here it's the opposite. You want to, I want to go short. I think this is going to fall. Where do you want to sell? I want to sell high. I want to sell here. Moderately overvalued. Okay? When I say sell, I mean where do I want to buy a put because I feel that this is falling. Okay? So that's where you want to buy your put because you feel that the put is going to increase in value because the stock price is going down. So this is your entry point here. Okay? Prices continue to fall. Let me get rid of some of this stuff. Okay? So here, this is the first location. We're following it down. Moderately overvalued bar segment. Prices fall. They continue to fall. Trend is still down. Prices bounce back up. Hit moderately overvalued again. Yellow again. Okay, I can add another contract there. Cool. I'm going to hold. Now I have two puts. It's still falling. It's still falling. Where's the trend going? It's going down. Now, what you could always do is here at the opposite value level, you can buy this, buy the put here, sell the put here. Buy the put here, sell the put here. Okay? And take these little trades, or you can buy the put and then just keep holding it until the trend changes down here. Okay, once the trend changes, then you can sell your puts from back here up here because you never know when this is going to continue down. Or you know, if you get some price separation, you can put your stop loss at break even here, stop loss at break even here, but you see how prices never get back up to that level. So you move to break even. Here we buy another put, continues down. I can show you this. It's so much to show you guys because we do this in the trading room with our divergence. But right here, this is most likely a divergence. First low, second low, and then prices bounce. But here you can, if you're still following the trade, you're still in it. And then right here, when MQ regression goes from red to green, now the trend has changed. So this is where you get out, right there. Okay, so your profits are based on a put bought here, a put, a put, a put. Now I'm out. This one's probably pretty close to break even, so you didn't make much money here, but you definitely made money here, here, and here. You followed the trend. Okay, that's a bearish trend. Oh, Sam, why not buy the put at the third bar? Yeah, you could have done it there too. I'm sorry. I mean, that's just, yeah, you could have done it there too. Okay, you don't have to. It's a trend following. It just happened to be that's the one I started out with. But yeah, you could have bought it there too. Okay. The reason why I didn't put the marker there, I was just saying like, oh, come in the morning and this is what you see. So you see the channel here and the channel here. You see the trend is down. That would have been my first opportunity. You have to have some run of prices to get a trend. So that way, I can't say, well, I buy it here. People will say, well, why'd you buy it here? You don't know what the channel is. So I give the channel a little run room. Yes, Giuliani. Here we're trading intraday. So yeah, I use tomorrow's Wednesday. If I'm going to be in and out of these trades the same day, I'm trading the ones that expire on Friday. Okay. It's the nature of the weeklies. Thursday and Friday, that's when time decay or theta really takes a hold of our weeklies. Isn't red a very value point to open a position? Yes. But the question is isn't this better right here? That red? Okay, that's fine. Let's just say it's red. If you get that. The problem is you don't get red here. You don't get red here. You don't get red here. You don't really get red here. So instead of buying 1, 2, 3, 4 options, you only bought one. Okay, you have to it's the nature. If you buy at moderately overvalued, then roughly 84 to 83% of the time, everything is below that. So it's enough of a move away from the center on the distribution that it's okay to buy yellow. What you're looking for is not to squeeze out the absolute last penny out of this trade. You do that, you're going to kill yourself trying to get the absolute last penny. This is almost good enough. Do you know what I mean? Because if you look at it, if I was able to buy a put here, it never really gets back up to that level. You buy a put here, that's the break-even level in price. It never gets back up to that level. It's almost good enough. Do you know what I mean? You want, if you can't over optimize a trade setup, or else you'll spend your entire day looking for the trade setup, and if it's too strict, you'll never get into a trade. You have too many parameters to meet in order to get into the trade. Here it's a kind of a general guideline, because if you're an active trader, you know that the trade setups almost never happen perfectly. So you want a setup that gives you some flexibility, as long as you understand the underlying reasonings behind the setup of the trade, then you can trade it pretty successfully. Okay? So this is the bearish trend on the spiders. Okay? Next is the bullish trend. It's the same thing. Here, we're watching the trend, Uh-oh, we changed. Notice how we go from a negative trend to a positive trend. So in this case, what we're looking for is a lower yellow bar segment, a moderately undervalued. And that's what we get here. And it goes up. So we buy a call here. goes up, comes back down. Here's another opportunity. Now, you can see that the intraday channel is sort of like this. It's not perfect, but it does have an upward slant to it, and it agrees with the MQ regression. It's going up. So we buy it there, and then prices come up, and then they come over here. Wow, okay. It's yellow again, lower yellow bar segment. Comes up, continues. Now we have market close. What do we do here? You can either decide to sell, because again, you are hitting significantly overvalued. It is the opposite value level. You could sell here. It's up to you how you want to trade this. To me, I don't like holding stuff overnight, so I'll sell it here. But when I come back in the morning, I see I gap up, but we look, you come back down. Trend is still up. I could buy here, moderately undervalued level. And then continue going. I actually think this is the day one. If I continue on, so I bought 1 call, 2 calls, 3 calls. Let's say I hold them. Here's the 4th one. I'm gonna flip over to the next slide, because here's that 4th one comes up. Here's the 5th one. Now be careful. I'm watching the MQ regression. MQ regression is starting to go shallow. See how steep it is here? See how it's getting a little shallower here? Okay, the channel is a little less defined. It's looking like it's kind of sideways here. So you want to be careful, because I'm holding these calls, and I'm like, okay, MQ regression is really kind of getting steep, shallow. It's almost flat. So you can start looking for a place to get out, because this really almost is sideways. So usually you'll see that. Sometimes what you'll get is you'll get a bearish divergence here. And when you see that, that's like the last hurrah, and then we start to change, and MQ regression changes. Okay, and then we switch, we sell our calls, and here we buy our puts. Now, Med, do I buy the first yellow? Yeah, you can do that, because you never know when you're going to get 1 bar or you're going to get 3 bars. Usually you can use that in conjunction with the MQ momentum. I don't have it on this particular screen, but if you watch your MQ momentum, here you'll have downside momentum, and then maybe your momentum will shift sideways and about to switch higher. Okay, as long as you get in proximity to these yellow bar segments, you can still, even if you say, okay, I'm gonna wait. See, I get yellow bar segments, so it's okay to buy. Which one do I buy? Well, maybe I'll wait till I get a higher high on this bar, and then that kind of confirms that we're starting to move back up. I'll buy it there. See, because I don't know if this is going to be yellow, 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 yellow. You know? So, again, you need to read your momentum, and if your momentum starts to go up, and then we get a higher high on the next bar, then it's okay. Okay, that's good. I'll go up. MQ regression is, again, it's just the trend direction. I like the steepness of the slope as giving me an idea as to how the trend is changing. Trend is very strong to the upside here. Trend is weakening here. Trend is about to change over here. See how the slope of this line? Don't even look at the color. Look at the slope. Okay? This is less steep. This is very steep. This is very steep. Okay? That's telling me the trend is strong. But I'm not saying, yeah, you could possibly do alerts. But I'm very visual when I trade. So, okay. So hopefully that answers your question. I use MQ momentum differently. MQ momentum gives me a ton of different types of signals. Okay, but let's keep going so I can show you guys more stuff. I know we have just about 10 minutes here. I do have more stuff to show you. So you guys hang out a little longer. I appreciate that. Again, here you can see the channel is definitely kind of defined. Here's the upper segment. Here's the lower segment. Lots of times the markets do this. Again, here, what color is MQ regression? It's green. You can buy here, buy here. Again, where do you sell? Buying is important. Selling is also important. You can buy here at the yellow. sell here at the yellow. If MQ momentum is still going up, like these, see the indicator line? It's still going up, so it's okay to hold that. Once this MQ momentum indicator line goes flat, see the blue line? Okay, then it's okay to sell. If you want to buy here, that corresponds to that green bar here. Look at the indicator line, it's positive. Look at the slope. I can hold it right to this level here. Then that will keep me in the trade, sell at this opposite value level. Okay? Here you can buy one more. Now, just looking, here there's a bearish divergence. It's not the prettiest bearish divergence, but usually this will knock you out, and then you'll sell there. And you can see how MQ regression changes from the positive slope to flat right here down to negative slope. So MQ regression changes color. Okay? You have to trade the strategy for a little while. Best thing to do, I would advise, is go back to maybe a 2 or 3 minute chart, back it up, okay, if you know what I mean, back it up, and just go forward one bar at a time, and just see what would I do if I saw that bar right there where, you know, MQ regression is red. I'm not going to get in a position because I'm looking for a yellow bar segment, not yellow down here. Okay, the move has already happened. It's more likely to go up. Okay, but read your momentum bars down there. All right, again, just a quickie. Which if I turn on my computer and this is where I am, MQ regression is going down, so it's okay to buy at yellow bar segment. So when I get to this level here, hold on. If the right side of the screen is like this and MQ regression is going down, I got a yellow bar segment here, and I see my momentum line is actually going down. It's okay for me to buy put here, one put, and prices go down. Once it gets down to this level, maybe I'll put the break even here. I can sell it here, or MQ regression still going down. I can hold it. I can see that, okay, the line's going down, it's going down. Okay, right here it went flat, so right here is where I'm going to sell it. So I bought the puts here and I sold the puts here. The value of those puts actually increased because the price fell. And then still going down, kind of bouncing. Now I can either buy here or here or here. If I'm watching MQ momentum, I'm watching the line is still positive. Right here it starts to go negative. So maybe in this area, this is where I'll buy more puts and then follow it down. Indicator line's negative. Probably right here is where I'd sell it. Okay, it's a feel thing. You got to try the trade in order to feel it. But you know, if you bought this and you just held it and didn't sell it until this MQ regression changes, then right in here is when you would sell it. You see, you do get a little bit of basic slippage because you have a little bit of a lag. That's why when I trade, I trade value to value. Okay. Yes, Brad. To answer your question, do I typically buy a Delta 70 in the money option? Yes, sir. Yes, sir. I buy in the money options when I'm trading directionally. Because if you think about it like this. You want to capture as much of a move as possible, okay? And you capture that move best with in the money options. They respond faster to a directional move in the direction you expect it to go. I could possibly buy a Delta 50. I won't spend as much money on that option, but the problem is if I'm right, I don't necessarily get the price movement in the option. It's half a dozen of one, six, half a dozen of one. It's about the same, but to me, I rather see changes in the price of the option when the underlying is moving. Okay, I get frustrated if I see a dollar move and the value of my option only changes 20 cents. Another reason why you have to be careful of the bid-ask spread. So I'd much rather see the movement. Yeah, well, that's for the spiders. And honestly, the question is you don't get much price movement. Well, I don't usually trade ETFs in my options room. I usually trade individual stocks. If I'm trading the Qs, the NASDAQ, and the Qs are doing something, I actually flip over and look at Apple. Apple usually does what happens in the Qs, and I make much more money. I make much more money trading that. Yeah. What do I trade most during the day? Spiders or Apple? I'll answer that question in a second, Robert. That's a good question. Yeah, stocks do have a wider bid-ask spread, but I really don't care about a 5-cent bid-ask spread if I can get a $1 change in the value of my option. If I go from 8 or 9 to 10 or 11, I will much rather I take that 20% change in the value of the option versus, okay, I'm buying the option for $1.05 and now it's worth $1.10. There's not enough price movement there to make it worth it. Can you make decent trades with Qs? Yes, you can, Chris. You can, but the one thing I would say with this, I want to show you the strategy. I want to show you the strategy on something that you're familiar with, but it can be applied to anything. Qs move a little bit better, but I actually played. I used Qs on. It was a 2:00 Fed announcement, and it moved, and we traded the Qs. I traded the Qs. I think I made $50, $60 trading like 20 or 30 contracts. If I traded the options on Apple or Google, I would have made several $100s and traded maybe over only 5 to 10 contracts. All right, so let me just summarize this. I want to answer some more questions, and then I'll show you some stuff because I think you guys have a feel for it, but you want to see some more stuff. So give me a chance to show you some more stuff. So the trending markets, even though they're intraday channels, that's kind of what you want to look for. They provide us with a lot of opportunities to profit. Now this is kind of important. Large and persistent market moves. If you have a channel that's going like this, you can make money. If you have a channel going like this, you can make money also. Sorry, ran out of slide space here. Here, if you're going sideways, it's harder, but you can do it. Just keep in mind your value levels and your support and resistance levels. You can do it, but it always helps. It's easier to do it with something that's actually trending. Now use the filter of MQ regression to keep you on the right side of the trading market. If it's going up here, you really don't necessarily want to buy puts. It's harder to do. Okay, here market's going down, you don't really want to be buying calls. Okay, until you get more experience. Now I'm using value bars to help you time good value-based entry levels. Okay, and then where to also sell them to help maximize profits. Now we're using options instead of buying the actual ETFs because that gives you leverage and minimize your risk. But we really don't have the risk. We're not going to let this thing go to expiration or something like that. I like the leverage feature. Okay.